thank you very much all for joining to the first event of our new seminar series on sustainability and the law. Thanks very much to the Society of Legal Scholars and Queen Mary to provide financial and administrative support for this series. What we aim to do with this series is to bring together practitioners, students, academics, people from legal disciplines, but also other disciplines, scientists and non-scientists, and create a forum where we can discuss climate change and how we can tackle it. In the context of that, we'll launch in the end of the seminar series, we'll launch a competition for students to submit essays to discuss their role as lawyers in climate change. So more to that at the end of the seminar series. For today, very happy to have Dr. Anna Christie presenting her paper on sustainable capitalism. As a chair today, we have nobody less than Dr. Tibise Morgandi. She's a lecturer at Queen Mary in International Energy and Natural Resources Law. And she's also a member of our Climate Emergency Working Group. So very pleased to have her. And with that, I'll give the floor to you, TV, and I'll switch to the next slide as well. There we go.
Thank you very much, Catherine. And I would also like to thank Francisca for this kind invitation. So as you can tell, I'm not David Whyte, and it's in a way difficult, to chair in his place because David has an incredible curriculum in this field, and as you know, is our new chair in climate crime and justice, and will direct the center in climate crime and justice. But I'm very happy to be here today. And as Catherine has said, I am a lecturer in international energy and natural resources law at the School of Law. And I also teach climate change as part of my course in energy law and ethics. So I am obviously, very familiar with the legal concepts that are involved in how we are trying to address these massive issues. I would say perhaps the most important issues of our century. And as a public international lawyer, I deal mostly with the international legal framework that tries to govern the way states respond to this issue. As Catherine was saying, I also sit on the board of the Climate Emergency Working Group, which is a working group that the Faculty of Humanities and Social Sciences has set up in December last year. And it's a very interesting working group because it brings together academics from different disciplines within the Faculty of Humanities and Social Sciences. So we have lawyers like me, we have political scientists, we have criminologists, we have people from the geography department, and also coming more from the business school and the art and literature fields. So it's an extremely interesting working group, and obviously is dealing with what we call the climate emergency. And although perhaps in some countries to say that we are facing a climate emergency would still seem as something which, might be unrealistic. We do know that we are facing a climate emergency, and we do know that we have to respond to it as quickly as we can. So this working group is meant really to, create a platform, first of all, for all our different disciplines within the Faculty of Humanities and Social Sciences, to create a bridge between the different disciplines, and trying to see how we can deliver some outputs that can be accessed by students, by other academics, but also by a broader audience, by the public, because climate change is that kind of issue where everybody needs to be on board. There are different stakeholders involved. Obviously, companies and states are at the forefront, but the public, us. And with climate change, you really need behavioral change if you want things to change. So this is, we're still work in progress. We will have a few workshops that will unpack several issues related to the climate emergency. But we have podcasts that are meant to be a kind of source that is easily accessible, that you can listen to while you go for a run, while you're driving, while you're chilling out at home, while you are on holiday. So that's the idea. Leave an output that can be accessed by everybody and that can unpack what the climate emergency is and how we can respond to that. And I think, this is all I want to say, because the real star of this talk today, of this first event of the Sustainability and the Law series, is Anna Christie, Dr. Anna Christie. And I will briefly introduce her. So Anna is an assistant professor of banking, corporate, and financial law at the University of Edinburgh Law School. She's also a research associate at the University of Cambridge Centre for Business Research, and she has broad research interests in comparative corporate governance and law and finance, with a particular focus on sustainability and climate change, ESG investing, and shareholder activism. And Anna will talk to us about the agency costs of capitalism. She has written a paper on this topic, and she will present the findings that are, distill some of the findings that are presented in her paper today. And we're very much looking forward to listening to her presentation. I think it's terrific to start with her today. So without further ado, Anna, welcome. Thank you so much for accepting Catherine's and Francisca's invitation. And we look forward to engaging with you in a meaningful discussion today.
Anna, you should be allowed to share the slides now.
Yeah, can you see them?
Yes, perfect.
Okay, great. Thanks so much for that really kind introduction and for the invitation to speak today. And thanks to everyone for coming as well. I appreciate your time. I'm having a little bit of problems with my mouse, so hopefully it doesn't disconnect during this presentation and I can move through the slides normally. Okay, so I'll start with a quick summary of the main ideas in my paper, the agency costs of sustainable capitalism, before explaining those ideas in a bit more detail. So the paper considers large asset managers assuming the role of sustainable capitalists. And I specifically focus on the big three asset managers, so BlackRock, Vanguard, and State Street. And in the paper, I propose a new agency costs theory of sustainable capitalism. And this theory builds upon a paper by Ronald Gilson and Jeffrey Gordon on agency capitalism, where they looked at the agency problems of institutional investors more generally. So put simply, I outlined that there are two specific problems that arise in a sustainable capitalism framework, namely the persistence of rational reticence on the part of institutional investors that we saw in the agency capitalism framework, and a second problem that I call rational hypocrisy. And together I label those the agency costs of sustainable capitalism. So those are the problems that the paper explores, and the rest of the paper discusses potential solutions to those problems. So in Gilson and Gordon's agency capitalism framework, activist hedge funds were described to be the potential solution to rational reticence. So they would act as what were termed governance arbitrageurs, so intermediaries, whereby they would initiate activist campaigns that then the more reticent institutional investors could choose whether or not to support. Therefore, the involvement of hedge funds served to mitigate the problem of rational reticence on the part of institutional investors. Similarly, sort of analogously, I argue in the paper that activist hedge funds focusing on environmental and social issues have the potential to initiate firm-specific ESG activism in a manner that appeals to and mobilizes the sustainable capitalism of the big three. And most prominently, one of the main solutions that I identify is ESG activist hedge funds playing a unique role in nominating specialist climate directors to corporate boards, with the big three asset managers then lending their support to elect credible director nominees. And here I draw on earlier empirical research I conducted for my doctoral thesis, which shows that activist hedge funds already have significant expertise in nominating board members to large companies. And the big three have also shown willingness to support board changes in various contexts. In the paper, I also touch upon other responsible activists who might also play a role as ESG arbitrageurs. And they might focus more on portfolio-wide ESG issues through the shareholder proposal mechanism. I also note that responsible activists can focus on the problem of rational hypocrisy and target their activism at the big three asset managers themselves. So that's just a brief summary of the main ideas that I cover in the paper and that I'll talk about today. Okay, so here we have Larry Fink, who is the CEO of BlackRock, which is the world's largest asset manager. And this is him at the World Economic Forum a couple of years ago in 2020. And he wore this climate change themed scarf representing the warming stripes visual, where the color of the stripes represents the annual average temperature of the Earth from 1850 until the present day. And the scarf served to emphasize Fink and BlackRock's professed commitment to putting sustainability at the center of the firm's investment approach. And he was being interviewed about his 2020 letter to CEOs. So he writes this letter to CEOs of BlackRock's portfolio companies every year. And the letter focused on climate risk and ESG investing. And I think this image really symbolizes how the big three asset managers have come to, at least outwardly, assume the role of sustainable capitalists. And to explain what I mean by sustainable capitalism and sustainable capitalists, essentially as governments have failed to take action on issues like climate change, there has been increased pressure not only on companies, but also on institutional investors to exercise greater social and environmental responsibility and provide market-driven solutions to these global problems. And just before Larry Fink made these announcements at the World Economic Forum, BlackRock, as a public company itself, had been targeted by other investors to take a more active role in climate change mitigation. Okay, so why is there such a big focus on asset managers and the big three in particular? So part one of my paper discusses the huge migration in recent years from active investing to passive investing and how this led to a massive aggregation of power among the big three asset managers. So the passive index fund industry is much more concentrated than the active fund management industry, with the big three asset managers, BlackRock, Vanguard, and State Street, offering passive investment funds at the lowest cost. So the result of this concentration is that the big three are the largest investors in the vast majority of economically significant companies in the US and to an increasing extent worldwide. And due to their passive index fund offerings, and an index fund is basically mechanically tracking the largest stock market indices such as the S&P 500 in the US or the FTSE 100 in the UK. As a result of that, the big three have very substantial holdings in the companies that have been identified as the key perpetrators of climate change. So the big three own more than 20% of the shares in most S&P 500 companies, which usually equates to around 25 to 30% of the shares that are actually voted, which is really significant voting power. And to provide one illustration of the power that they have, I've included this table on the slides of the 8 largest oil and gas exploration and production companies in the US. And as you can hopefully see, in each instance, the big 3 collectively hold more than 20% of the shares. So the paper essentially starts from this standpoint that the big 3 increasingly assume this role of sustainable capitalists, and then it moves on to explore some of the problems that might arise from them playing that role. So to do this, part 2 of the paper builds on Gilson and Gordon's theory of agency capitalism. And in that paper, they considered the problems that arose from the divergence of interests between institutional investors and their ultimate beneficial owners, so the people whose money they invest. And in the paper, they mainly focus on active mutual funds and to a lesser extent, pension funds. And they describe institutional investors in this agency capitalism framework as rationally reticent. So these investors will only respond to proposals initiated by others rather than pursuing an activist monitoring role themselves. And the solution that Gilson and Gordon put forward in that framework was for activist hedge funds to act as what they called governance arbitrageurs. Analogously, I developed a sustainable capitalism framework for analyzing the gaps between the interests of the big 3 and the interests of the diversified index investors that they ultimately represent. So the passive index fund investors whose money the big 3 typically manage invest in fully diversified index portfolios, or they may have explicitly chosen to prioritize social and environmental goals and values by investing in bespoke ESG funds. So I argued that this dual problem arises in the sustainable capitalism framework. Firstly, the rational reticence that we saw in institutional investors likely still persists on the part of the big 3, but they also might exhibit what I call rational hypocrisy. So the potential solutions to this dual problem are, however, more complex than the solution that was advanced in the agency capitalism framework. Okay, so looking a bit more closely at the dual problem, I'll just start with rational reticence. So here, in terms of sustainable capitalism, I think it's necessary to distinguish between rational reticence in respect of firm-specific monitoring versus portfolio-wide initiatives. So the big 3 asset managers differ from the institutional investors that were examined in the agency capitalism framework, as they are common owners, so they hold shares across sort of all companies, and they increasingly manage bespoke ESG funds. So these factors in particular could prompt the big 3 to engage in more active, not really activist, monitoring, at least with respect to portfolio-wide issues, so issues that are affecting companies across their portfolio. Firm-specific risk can be mitigated by diversification, whereas diversification doesn't solve the problem of climate risk. So as the climate crisis poses a significant risk to the economy generally, and the losses caused by climate change are likely to be widely diffused and very large, diversified shareholders cannot eliminate this risk. Therefore, the interests of the big 3 who manage money for fully diversified passive index investors can differ markedly from the interests of more concentrated shareholders who focus on firm-specific risk. So the big 3 and other large asset managers might therefore be expected to internalize negative externalities in order to minimize risks associated with climate change, given its detrimental effect at the portfolio level. So we might expect the big 3 to initiate some portfolio-wide sustainability improvements in order to mitigate this portfolio-wide climate risk that they can't mitigate through diversification. There's also some precedents of the big 3 engaging in portfolio-wide activism. So for example, in the area of board gender diversity, they have succeeded in targeting and persuading a wide range of companies to add women directly. So theoretically, when analyzing rational reticence in the context of sustainable capitalism, in the context of the big three, we might expect these asset managers to exhibit less rational reticence on these portfolio-wide sustainability issues compared with the active fund managers that were analysed in Gilson and Gordon's paper. On the other hand, the big three in their role managing passive index funds do not generally have an incentive to engage in firm-specific activism. So the business model of passive index investing is simply to replicate the performance of specific stock market indices and to minimize the costs for end investors. So index funds compete on cost rather than on relative performance. So when we look at firm-specific monitoring and activism, the rise of passive investing would logically appear to exacerbate the problem of rational reticence. So just to summarize, it's likely that rational reticence on the part of the big three and other asset managers is more pronounced in a firm-specific context rather than in terms of portfolio-wide initiatives. And then secondly, just to look at the problem that I've called rational hypocrisy, if we examine the disparity between the big three's rhetoric on sustainability and their actual actions in practice, what they're actually doing, that exposes a second problem in the sustainable capitalism framework, and that's the risk of rational hypocrisy. So in the media, BlackRock in particular has been regularly accused by environmental activists and others as being hypocritical due to discrepancies between its public statements on climate risk and its actions in practice. And there's various reasons why asset managers such as the big three might have strong incentives to claim that they uphold a higher commitment to sustainability than is actually the case in reality. For example, being perceived as environmentally or socially conscious could bring greater or equal benefit to the big three than actually going through costly processes to substantively challenge managers on tough issues in a meaningful way. And being perceived in that way can help the big three to attract investors' money. It might mitigate consumer and employee backlash against the big three. But in practice, when we examine the big three's voting records, and particularly the voting records of ESG funds, it supports a view that the big three are displaying this rational hypocrisy. And although the big three's support for environmental proposals has increased, especially over the past year or so, there is still a disparity between the commitments made and the corresponding action in practice. So combine those two problems of rational reticence and rational hypocrisy. I have in the paper, I describe that as giving rise to what I've called the agency costs of sustainable capitalism. So there might be a divergence between the big three's actions on climate and the rational preferences of diversified index investors or ESG investors who are generally thought of as a proxy for society as a whole. Then we look at possible solutions. So in Gilson and Gordon's agency capitalism framework, the solution that they put forward was for specialist activist hedge funds to fill the monitoring shortfall. Looking at the sustainable capitalism framework, in the paper I talk about two different general categories of investors who are potential candidates to solve the problem. The first is ESG hedge funds, and the second is other responsible activists, which is sort of just a general category I've used to describe organizations like non-governmental, climate organizations, religious organizations, pension funds. So taking ESG hedge funds first, I don't imagine that hedge funds are usually the first actor that springs to mind when thinking about sustainability and climate issues. So on the slide, we have some common criticisms directed at activist hedge funds. Elizabeth Warren, Hillary Clinton, Bernie Sanders have called them hit and run activists. A German politician called them swarms of locusts, and they've been described as preying on corporations and a disease that affects American business. However, a vocal minority of activist hedge funds have recently begun to specifically pursue environmental and social goals in their activism. So the question then arises, can hedge funds really move from a greed is good mentality to a green is good mentality? Is an ESG hedge fund an oxymoron, or can they in fact play a valuable role as ESG arbitrageurs in the sustainable capitalism framework? So when thinking about this question, it's useful to take a step back to consider how activist hedge funds have evolved. So in other research, I conducted an empirical study tracking the evolution of activist hedge funds from the most commonly criticized approach, which is sort of financial engineering, balance sheet activism, which I've labeled activism 1.0, to what I call activism 2.0, where hedge funds initiate much more substantive forms of activism, such as proposing detailed and long-term strategic and operational plans to corporate management. So it's much more like a sort of management consulting or private equity approach to activism. And this substantive activism is almost always accompanied by activists nominating directors to target company boards. So through my empirical research, I discovered that in activism 2.0, activist hedge funds that sought board representation held shares for much longer periods, and they generally initiated strategic and operational improvements at target companies. For example, activists often nominate directors who have a wealth of experience in the relevant industry in order to facilitate a turnaround of a failing business division or a failing company more generally. The longer term nature of these campaigns also appeal to institutional investors whose support the activist hedge funds rely upon in order to succeed in their campaigns. So it's through this sort of activism that I think that hedge funds serve a particularly valuable function to act as governance arbitrageurs in the Gilson and Gordon framework, and to fill that gap left by institutional investors with regard to firm-specific monitoring. So they can mitigate this rational reticence on the part of institutional investors by proposing these detailed firm-specific improvements that institutional investors wouldn't themselves propose, but that they're willing to get on board with and support the activist hedge fund in doing so. So then can hedge funds continue to evolve further to become ESG arbitrageurs, focusing their efforts on environmental and social issues rather than shareholder value, solely looking out for financial gains? And a striking example of this is a recent activist campaign at ExxonMobil, which was the first boardroom battle to focus on the issue of climate change and renewable energy transition. So last summer in June 2021, Engine No. 1, which was a new impact hedge fund set up in December 2020, successfully replaced a quarter of ExxonMobil's board of directors, to the shock of everyone. What was unusual about Engine No. 1's campaign at Exxon is that Engine No. 1 is a tiny hedge fund. So usually these types of campaigns will be conducted by really formidable, well-known, well-financed activist hedge funds, especially when they take place at companies as large and as powerful as Exxon. And activist hedge funds usually buy a relatively substantial percentage of shares in order to launch their campaigns. So they'll still almost always be minority shareholders, but I think the average shareholding is around 6% to 8% of the company that they'll take shares of. Whereas in Engine No. 1, they only had 0.02% of the shares in Exxon, which is a really small percentage to sort of make such a bold move as to replace a quarter of the board. So this led to the campaign not being taken that seriously by some in the early stages, because it was effectively this startup hedge fund and they only had a 0.02% stake in this giant oil company. And the reason a campaign of this nature would normally only be conducted by a well-known established activist hedge fund is the cost. So proxy contests, which is the technical term for contested director elections at companies, they're super expensive. So Engine No. 1 spent around 30 million on the proxy contest when they only had a $50 million stake in the company. So in that particular instance, their costs likely outweighed any profit they made from the intervention. And because of this, their small stake and their lack of reputation in activist campaigns, what was fundamental in this campaign was the credibility of the independent director candidates that were put forward and the support engine number one could generate from other shareholders. So their campaign initially got a big boost as they secured support from the 3 biggest pension funds in the US. And then the campaign ultimately turned on whether the big 3 asset managers would vote in favor of the director nominees. And as I illustrated earlier in the presentation, BlackRock, Vanguard, and State Street collectively held over 20% of the shares in Exxon, so they are the pivotal voters in any campaign like this. As it happened, all of the big 3 asset managers voted in favor of at least some of engine number one's nominees. So 3 out of the 4 nominees were ultimately elected. And this was the first ever proxy contest to focus on an environmental or social issue. But it is important to stress that the hedge fund centered the campaign both around climate issues and financial issues. So they really hammered home the point that climate risk is financial risk, and the fact that Exxon's financial performance had really lagged its peers in the industry, peers that had made more of an effort to facilitate an energy transition and move away from such heavy reliance on fossil fuels. So going back to the theory, the question then arises whether hedge funds pursuing ESG goals can mitigate these agency costs of sustainable capitalism in a similar way to how Gilson and Gordon described more traditional hedge funds as mitigating the agency costs of agency capitalism. So in the paper, I used the example of ExxonMobil and engine number one to show that in many ways, these environmental and social campaigns can directly parallel the type of campaigns that were particularly beneficial in what I described earlier as activism 2.0. So namely, when hedge funds are appointing directors to corporate boards with the support of institutional investors, and in particular big asset managers, they tend to focus on more substantive long-term value creation rather than the more controversial financial wizardry that activist hedge funds are more commonly criticized for. And similarly with environmental and social issues, hedge funds could potentially play a unique role in nominating specialist directors to corporate boards, such as those with expertise in climate or the renewable energy transition. So in the paper, I argue that portfolio-wide initiatives can only go so far, and what is often needed is firm-specific intervention, which focuses on these detailed plans of company strategy and operation. So very similar to activism 2.0, but in an environmental and social context. And again, the Exxon engine number one case can illustrate the benefit of this firm-specific activism and the benefit of an activist hedge fund getting involved. So in Exxon, more traditional institutional investors, such as pension funds and other responsible activists, such as NGOs and religious groups, they had been campaigning at Exxon for years, submitting shareholder proposals year on year, trying to push Exxon to disclose its emissions, to commit to a clearer strategy for renewable energy transition. And that had been going on for years with sort of varying levels of support from the major asset managers. But then once the activist hedge fund got involved in December and launched the proxy contest to add new directors to the board, things moved incredibly quickly. And just by way of background, there's sort of 2 ways that activist hedge funds can gain board representation. They can launch a proxy contest, so that's a formal election contest for board seats where all the shareholders will vote on the nominees. And that's what we saw in Exxon engine number one. Much more typically, more established hedge funds will gain board representation through settlements or even through being invited to sit on a company board. And when I did my empirical study looking at more traditional forms of hedge fund activism, the vast majority of board seats were gained through settlement agreements rather than formal proxy contests. Exxon also went down this route themselves. So the Exxon case is actually a good example of both types. So after engine number one launched its campaign, Exxon invited another veteran activist hedge fund manager to join its board. So they voluntarily added Jeffrey Ubben to the board of directors, and he is the former head of a very well-known activist hedge fund, Value Act Partners, which he had recently left to set up a new ESG hedge fund called Inclusive Capital Partners. And although Exxon is the only contested election of this type, there are also recent examples, which I've highlighted in the paper, of established hedge funds taking board seats at companies in order to help the companies focus on renewable energy and the energy transition. So there are like less dramatic examples of a sort of similar phenomenon. So these strategies that hedge funds use are different from the strategies of other shareholders. Therefore, I conclude in the paper that it may be that ESG hedge funds are in the best position to pursue some of the most valuable types of activism, such as appointing climate directors who can provide insights and expertise with respect to energy transition. And then finally, just to conclude on the point of sort of the role of other responsible activists and how they might fit into the sort of role of ESG arbitrageurs in the sustainable capitalism framework. So other responsible activists, so often NGOs, religious organizations, pension funds, as I've said, they mainly look at portfolio-wide ESG issues, and overwhelmingly they're proposing sort of fairly standardized shareholder proposals to a lot of different companies. Therefore, they would mostly mitigate portfolio-wide rational reticence rather than firm-specific rational reticence. And to some extent, the big three already seek to bring about similar changes to those sought by responsible activists in these shareholder proposals. So the big three do these behind the scenes, private. It used to be more private. They're becoming a bit more transparent about what they're actually doing now in their sort of sustainability reports. But they do these private engagements with corporate managers on these issues. So there's a bit of overlap between what other responsible activists are doing and what the big three are trying to do themselves as well. And there are some examples of the big three refusing to support some of these shareholder proposals on the basis that they're already engaged in a dialogue with the company on similar issues. But just sort of final slide, just to round up on the point of rational hypocrisy. In the paper, I argue that the problem of rational hypocrisy may require a different approach. So here I look at responsible activists and interest groups and how they can potentially, and how they do target their activism at the big three themselves. So they'll draw attention to discrepancies between the big three's rhetoric and their voting and engagement sort of records in practice. There's various means to do this, such as ranking asset managers on the basis of their voting and engagement records. And there's sort of these reports that are published, which I've put some examples on the slide, which have become increasingly commonplace. So these sorts of approaches might help to mitigate rational hypocrisy as these interest groups are sort of constantly trying to shed a light on what's actually happening in practice and exposing any discrepancies between the words and the actions of the big three and other large asset managers. And again, this was a feature of the Exxon Engine #1 campaign, as climate activists were targeting BlackRock in particular for its votes not matching up to what it was saying on climate change. So when the directors, the voting happened at the shareholder meeting, everyone was really watching BlackRock to see if it would vote in favor of Engine #1's nominees, which also shows how the campaign was really perfectly timed by the hedge fund to sort of test the credibility of these actions, sort of the statements of the big three, and to use that in the furtherance of their campaign. Okay, so that concludes my presentation, but I'd love to hear any questions or comments.
Thank you so much, Anna. A very insightful presentation, and I'm sure there will be many questions. If I can abuse my position as chair and just ask one question, but then I really want to open the floor, and I already see Eva and Catherine who have raised their hand, and I encourage all the audience to engage in the conversation. And if you want to ask a question, just use the raise hand function so that we can go in order. So it was very interesting to hear that ESG hedge funds may be leading the way. And this strategy of nominating what you were calling energy transition directors, you know, to the board of directors. But what I was interesting to hear is whether the nomination of these energy transition directors necessarily translate in the adoption or the, in energy transition investments per se. Perhaps it's too early to already see, these happening, but what is the relationship between these two?
Yeah, so I think that's sort of a common criticism of the Engine #1 campaign. A lot of people have criticized and saying, well, yes, this hedge fund got these independent directors on the board, but what are they actually going to do? Are they really going to transform Exxon into a completely different company? And I think unlikely, perhaps. Hopefully we'll see some transformations and some progress. How quick that progress is debatable. I mean, Exxon came out with I think they have their new net zero plan I think that they released that in January, which is obviously the first of them doing that compared to other oil companies who've done that much sooner. So I think we will see change, but how much change is debatable. But what I thought it was interesting to do in the paper was to look at what had happened in analogous campaigns that weren't about climate. So if a hedge fund invests in a company, for traditional activism, for financially oriented activism, if they're not on the board, there tends to be a limit to what they can do. So that type of activism was much more financial in orientation, because they don't have the information that they get from being on the board. They don't have the influence they have from being on the board. But once they get people into the board, you can see these campaigns they're very different from the campaigns where they're not on the board. So I think that's a reason to be optimistic about the potential influence and change that could be brought about by sort of having these climate directors on the board. But again, I would say that's always, we always have to be realistic in terms of how much change can be brought about by that. And also remembering that these directors are independent directors. They have the expertise. They're not employees of the hedge fund. They're independent people with expertise in the industry. But in a different context, we have seen that having quite a bit of impact. So perhaps some reason for hope.
Well, I guess, when you look at oil companies, I mean, they make money out of digging out oil. So in a way, it makes sense that their investments go in that direction. But I think nowadays, with the development of technologies like carbon capture and storage, you can say, well, you can still dig out oil, but if you capture your emissions, you can do it in a more sustainable way. And many oil companies are going in that direction. So I think it's also about tweaking the investment, not just shutting down a business that is directed at digging out oil, because then they make no profits. But very, very interesting to see how the landscape is changing. Thank you for that. Eva and Katrin.
Yeah, so thank you very much for a wonderful paper. I think it's really important that we integrate sustainability into corporate governance. What I'm wondering about the paper is whether or not you should be tracing the agency capitalism paper as much as you do. And I say this because the agency capitalism is very firmly about shareholder value. And this is not what your paper is about. So your paper focuses, like the agency capitalism paper, on the role of intermediaries, but you're not really interested in shareholder value. So in your paper, the principle is probably E and S factors, and because you're so close to the Gilson paper, that kind of gets buried in. I haven't read the paper; I've just listened to your presentation, but that kind of gets buried as a message, and then it becomes slightly inconsistent.
Mm-hmm. Thanks for that comment, Eva. That's helpful. I think Yeah, I mean, I take the criticism about, you know, environmental and social issues versus shareholder value, but I think this is all still sort of happening in the context of capitalism. So when you think about the role of hedge funds, they're only going to intervene in companies if they think they can make money as well as pursue environmental and social goals. So the two will always go hand in hand, I would argue, unless it's in the engine number one campaign, it was a little bit different because I don't think they made a lot of money from that, but they did it for sort of, it was done for different reasons, marketing potentially, and setting up new funds to attract investment and things like that. But I think that is a limitation of the role of activist hedge funds, is that they will always be seeking this sort of double bottom line. Even if they're pursuing environmental and social goals, it will also be about shareholder value. It has to be, that's kind of in accordance with their business model. And they're very transparent about that. Even these new ESG funds, they always say this is about making money as well as pursuing environmental and social goals, which is all very well as long as the two can go hand in hand. I think now where we're seeing issues is, you know, ESG has sort of been booming for the last few years, but now it's starting to sort of crash a little bit, and that becomes a bit more difficult when there have to be sort of more trade-offs between the two. But I think in the paper, I'd really looked at this through the context of what I've called sustainable capitalism. So it's still a capitalism framework. It's still business, and it's not purely environmental and social goals. And I mean, some of the other investors might be much more genuinely interested in environmental and social goals. So when we look at what I've termed responsible activists, they tend to, maybe you might term it, more genuinely interested in these goals.
Thank you.
Katrin.
Yeah, thanks so much, Anna. This has been a really interesting presentation. I think the question partly relates to your answer to Eva as well. But it's, I'm sort of, and maybe that's also because hedge funds, as you said, are not necessarily the first one that sort of come to mind when you're thinking about the ones that are going to solve sort of our unsustainable financial system. But there's actually two things that I'm sort of find a bit awkward with sort of providing them with this role. And the first one is, to what extent is this actually something that we can see as a mainstream thing? Because I can see, I mean, universal owners, they're huge, they are systemic. I mean, they are system-wide investors. They are here to stay. It's passive, so they're going, like a lot of passive investment, they're going to stay here for a long time. With like hedge funds, I don't see, I mean, obviously you have a few sort of marketing stunts, but then apart from that, how mainstream is this actually going to be as a strategy? Because it's a very specific strategy to sort of make money out of this. That's the first question. So like, because I can see it's a marketing strategy for bigger hedge funds to sort of get a better image, or you can have sort of something like engine number one that like sees this as a way to launch their name because everybody talks about it now. But I'm wondering to what extent it's going to remain a niche thing. And then the second thing that I'm sort of, I find a bit confusing with like seeing hedge funds as sort of the at the forefront of this, is that, I mean, climate change, particularly, the problem is something that's so long-term, even long-term, that long-term investors in the market probably goes beyond long-termism in the market because it's intergenerational. So I'm wondering to what extent this type of interventions is actually something that could help like really tackle climate change. Because you get directors on the board, but is that really something that creates true long-termism from a climate change perspective, or is this really just cosmetics? And is this, because the reason I'm thinking about it is because I'm, there's this Harvard case study on GPIF, the Japanese pension fund, who has both sort of the system-wide perspective and it's very long-term because it's a pension fund and they need to sort of fund pensions over generations, right? And GPIF, the Japanese fund, owns about 1% of global stocks. and they have been quite active in ESG. And for me, they seem, because they have both a system-wide perspective and long-termism in mind, they seem like a better suited to that role, I guess, and activists that are very profit and short-termist. That's my question. I don't know if you have any thoughts on that, or whether I'm being too pessimistic about their role as ESG activists.
No, thanks, Catherine. That's a really helpful question. I think sort of taking the first part, whether this is going to be a mainstream thing or if it's going to be niche, I think it's really hard to tell because, you know, although these cases are sort of dramatic, at the moment they are pretty niche. There's not many cases like this happening. Sort of ESG activism on the part of hedge funds, we only really saw it beginning in 2018. That was the first of some of these impact hedge funds being set up. So it's very new at the moment. It's very niche, although there's a lot of, you know, talk about this on investors' websites and things like that. So it seems to have potential, but whether it becomes mainstream, I think it sort of remains to be seen. In terms of, I think there's always a problem when you're talking about firm-specific changes, is that it's only the firms that are targeted that are then going to have change. So when I looked at, so my empirical study looked at the S&P 500 and looked at sort of what had happened at various companies being targeted for activist board representation. And it was about 20% of the S&P 500 had been targeted for activist board representation, had got directors on the board from hedge fund activists over the last 10 years. So just to give an idea of how mainstream it could potentially be in the context of financial activism, that's about 20% of the largest 500 companies in the last 10 years. So it's always going to be a subset of companies, firstly. But I think there can be knock-on effects, right? Because if other companies see Exxon being targeted in this way, there's a whole industry of shareholder activism defense where boards will get worried about this, their advisors will advise them about this, and it's like how to protect your company against activists. So a lot of companies will put in place changes that activists might ask for in advance of them being targeted, in the hope that they never get targeted. So there can be these sort of additional benefits. So if this did become a bit more mainstream, then we might also see companies sort of defending themselves in this way by preemptively putting in lots of environmental and social sort of initiatives, which I think they're doing anyway, because they're being targeted by, you know, engagements with the big three and just general public pressure and things like that. But yeah, I think it's still an open question how mainstream this might become. In terms of your sort of the second part of your question, which is sort of around the appropriateness of hedge funds even sort of being considered as a player here, in terms of, because obviously they're shorter term investors than what we might see as even medium term, long term investors, and climate change is obviously a long-term problem, but I think it's also an urgent problem, right? And what hedge funds are particularly good at is doing things fast and creating change fast. So I think if there were hedge fund involvement, it can be good for creating sort of urgent change. In terms of the long-termist impact of that, I think directors can have a long-term impact. I think one benefit of putting sort of non-affiliated independent directors on the board is that even once the hedge fund is gone, those directors will probably stay on the board. Whereas if the hedge fund's putting their own people on the board, they tend to, they'll leave the board when the hedge fund exits as well. So I think there is some potential for sort of long-term change and benefits there. But again, I absolutely take the point. I think if we're in an ideal world, we wouldn't want hedge funds to be doing this. But I just think in the system, we want the government to be doing things. We want international communities to be doing things. But within the sort of corporate governance system, I think there might be some reasons to be just a little bit optimistic about what hedge funds potentially could do in this regard.
It's all an alternative to just having a carbon tax globally.
Yeah, exactly.
So
this wouldn't be my first choice of a solution, but I still think it's interesting to explore.
I'm very receptive to that. Yeah.
There are a couple of more questions in the chat. The first is actually very long. I don't know if you see it, Anna. I don't know if it's easier for you to read it and for me actually to read it out loud. The second is a bit shorter, but perhaps I can read that one.
Yeah, so the first one from James Cripps is the reason why large ESG managers do not want to be active, largely costs in a market where fee competition is measured. Yeah, so there's a lot of papers about sort of the general incentives for asset managers and other institutional investors, why they don't have incentives to be activists, and why they'll much more likely just to respond to the campaigns of others rather than to create their own campaigns. I think a lot of that is to do with costs and sort of the benefit that they'll get out of it. So there's sort of collective action problems, free rider problems. If one investor really spends a lot of money, then everyone benefits, but they've had all the costs, which makes them uncompetitive. So it's sort of the traditional incentive structures that have been studied in depth in a lot of other papers. In terms of ESG, I think there is some work about how big asset managers are actually trying to compete on ESG platforms now. So they are investing more money in this. They're sort of getting a lot more people in their stewardship departments to do these sorts of things, and they're marketing themselves through their sort of sustainability reports for investor stewardship. So I think they are under a lot of pressure to do this, but again, there's always a matter of how much money do you want to spend on it that then impacts your profits.
I think there is a last question. I don't know if you want to take that one, and perhaps we can close with these, which has to do with national oil companies. So despite the large players on your slide, the national oil companies remain much larger. How far can they be influenced by the activism we are discussing, as opposed to the latest IPCC report?
Yeah, I mean, I think national oil, I'm just looking at public companies. National oil companies are much harder to reach through activism generally, because they don't have public shareholders, and yeah, so and obviously they're controlled by governments and countries that are very difficult to influence. So I think that might be, I'm sort of starting to look at some of these issues in other research, sort of looking beyond the public company to national oil companies, private companies, that sort of thing. But I think in terms of activism and shareholders, it's really public companies that we're looking at there, and obviously that's still missing a massive. Many of the biggest oil companies are national oil companies, so that's still something sort of the governments need to sort out.
Anna, thank you so much for your time today and for this fantastic presentation. I'm sure people will be thinking about this over the next few days, and I think be great also, to read your paper, because I'm sure it goes much more in detail. But congratulations, it was really a fantastic presentation. I'll give back the floor to Katrin, who is now going to present the student competition.
Thanks so much, Anna. I really enjoyed it. Let's hope that the whole sort of sustainable finance revolution makes sort of the hypocrisy a little bit less feasible as a strategy. Just as a last 30 seconds, we would like to introduce the competition that we're launching for students. I know Franziska, she's on the line as well, so she'll be introducing that for us. She's co-organizing the seminar with me, so I'm very happy that she can be on the call as well.
I'm indeed on the call. Thank you very much. And first of all, many thanks to Dr. Anna Christie for this fantastic and very insightful presentation. Many congratulations on the paper. And also thank you to Dr. Tibisi Morgande for stepping in as our chair today. Now, my ears pricked up particularly when the discussion turned to climate directives. And what struck me was that over the next decade or so, many corporates will have to develop a compliance, environmental compliance function. And so not just having a climate director, but also a regulatory corporate finance, corporate governance function that extends into environmental issues more specifically. And this brings me on to our student competition, which we are launching today, in which we want to ask students on their views on two topics. First, how can lawyers play a role in advancing the sustainable agenda? Is there a duty, for example, to warn clients of climate issues, even if that's not specifically the area your advice is being sought? But also secondly, and more immediately, what contributions can students make to a sustainable law school? And I'm sure there is a fair bit of rational reticence and hypocrisy as well, and what we say we want to do and what we're actually doing. So any students listening this evening, please take part in this competition. We're not expecting a big dissertation or a big essay. Really what we're looking for is a short piece of around 500 words, could even be of blog style. And out of these submissions, we will pick 3 finalists for which there will be a certificate and a sustainability prize. So excuse me, so probably nothing on printed paper here. So please do take part, send us your ideas. The submission date is 10th of June 2022. Please email it to me, to Katrine, or to myself. And also, finally, many thanks to the Society of Legal Scholars, who very kindly provides us with funding for this project. So I'm handing back to Katrine. Thank you.
Thanks so much, Franziska. I think this just allows me to conclude the event. Thank our speaker. Thank Phoebe for chairing. I think this is super interesting. I'm very happy to have this as our first event of the series. We'll have another event that we'll advertise in the same manner. And the 3rd of May, we'll have Andy Russell, who is a geographer from the geography department, and he will talk about his research on the relationship between sort of his scientific work and then climate policy. So stay tuned, we'll inform you about the details, but very happy to see you all there again for a truly interdisciplinary discussion again between scientists and lawyers. So I'm very keen on that, and I hope to see many of you there. So that's it. Thanks so much all for joining. Thanks, Anna. Thanks, Stevie. I really enjoyed this first seminar.
Pleasure. Bye-bye.
Thanks so much. Bye.
Bye.